Home buyers want to know, where are mortgage interest rates headed? And they want to know, is the Fed going to raise rates more further? But this is actually the wrong question to ask, and I'm going to show you why in this video and what the important information is that you need to know in order to predict where interest rates are headed next. Hi, I'm Nicole Hamilton, a home financing and home ownership expert. Subscribe to my channel and you'll be the first to know when I upload a new video. We all know why mortgage rates are important, because your monthly payment will be higher if mortgage interest rates are higher. And you can always refinance, but it is a long process and it's not always assured. So that's why people want to know where interest rates are going. But not knowing can cause paralysis. And it can really get sand in your gears if you're waiting for something to happen and you're not sure exactly what. In general, when you have uncertainty, it can be very useful to look at historical data about where mortgage interest rates have been. Just like with anything, looking at long-term trends can be very informative. And understanding where they've come from can give you important insight on where they might be headed next. Stay tuned till the end of this video to get my free resource for home buyers. To understand where mortgage rates are headed, let's look at the past to see if we can find patterns that might inform us about what's coming up next. Before we start, here are a few facts about mortgage interest rates that a lot of people just don't know. Mortgage interest rates don't track along with the Fed funds rates. You hear that the Fed is jacking rates up. That's the federal funds rate. The federal government has been adjusting that rate up in an attempt to control inflation. Mortgage rates track along with something called the 10-year treasury yield. The federal funds rate tracks along with short-term debt like credit cards and personal loans. The correspondent lending rates that banks use is called the prime rate. Here's a chart that shows the federal funds rate, and you can see that the prime rate tracks right along. Here's the mortgage interest rate. Now let's look at a chart that shows the relationship between the mortgage interest rate and the 10-year treasury yield. Here's the 10-year treasury yield, and here's the 30-year fixed mortgage. You can see how they track right along with each other. Given all this, what are some things that influence the mortgage interest rate? The Fed buying and selling debt securities. Supply and demand in the mortgage market when lenders have too much or too little business. Inflation. The secondary mortgage market. When investor demand is high, mortgage interest rates trend a little lower, for example. All these factors create a stew of influence, which makes it difficult to tell where mortgage rates are headed. So let's look back at history, and let's look at the history of mortgage rates and see if we can pick out any patterns. Here's a chart of mortgage interest rates for the last 40 years. You can see that rates were in the 5% to 10% range for the period leading up to the Great Recession, at which point they dropped down and cycled below 5%. The period between the Great Recession and April of 2022 is the only period in the last 40 years that mortgage interest rates have been below 5%. So if we're thinking rates might drop, let's think about what caused rates to drop in previous years. The big factor is an economic crash, where the Fed wants to stimulate the economy by making the cost of borrowing money lower. So if I had to put my money on when we'll see rates below 5%, because remember, historically they only went below 5% after the last economic crash, I would predict that the next time we see rates below 5% would be in the next economic crash. And during economic crashes, it can be the most challenging time to buy a home because everybody's trying to deal with this major economic event. That's just based on trends. And check out the notes below because I include all the links to the charts and other helpful information so that you can look at this data too. Your best bet is to accept the current environment as the new normal, where rates are going to cycle above 5% as they have done historically, and make your decisions accordingly. To get on the path to homeownership in any interest rate environment, use my free resource called The Formula for Homeownership. I'll put it also in the notes below.